What is up, everybody? Welcome back to another episode of Bitcoin and Markets. Merry Christmas. Hope you guys had a good Christmas out there. We are going out on the 26th of December. Took the day off yesterday, did not put out a weekly fundamentals report, but we will get back on track here in the coming week. So what did I want to cover today? I mean, there's some big news out there about Barry Silbert, and he is resigning from Grayscale. And that's kind of big news. People are talking about how that means, they're one step closer to converting to an ETF. We'll take a look at the premium and discount on that. What else did I have here? We're going to go over price, Bitcoin price, look at how that is shaping up for the coming weeks because, that deadline is coming up January 10th. And finally, a few more, mempool and ordinals, AI. So the thumbnail is about AI and how AI needs Bitcoin. So we're going to go over some of my thoughts that I tweeted out today. And finally, take a look at a recent blog post I put out about the shale revolution and how it is probably the biggest geopolitical event since the fall of the Soviet Union. So that's all what we got going on today. Let me share my screen and jump into it. Where do I want to go first? Where was I? How about here? bitcoinandmarkets.com. That's the homepage for all of my content. I put out a professional tier letter on, I think it was Friday or Saturday, and we talked about a quick Bitcoin update going into the end of the year. And of course, you can see my shale and earthquake in the geopolitical order. That was a post that I also put out over the weekend. That went out first to paid members, $5 a month. You can support my content, and you can also get immediate access to all the blog posts. And then I put them out public later. This one has been made public, so you guys can go over to the website and check that out. We'll be reading over that a little bit more later. Okay, let's go to the charts. Bitcoin price. Price is everything. I saw some people talk about this on Twitter already today about, I think it was in regards to one of George Gammon's tweets. And yeah, price is everything. If Bitcoin was a constantly depreciating asset, we wouldn't be here. Okay. So price is what drives everything in this. We wouldn't have all the good benefits that Bitcoin promises to bring if price didn't first go up. So that is the most important thing, in my opinion. Of course, I'm kind of biased since I'm an economist. I've been a gold bug, sound money guy for a long time. And, this is where I kind of entered the space, was from the economics, number go up, that sort of thing. But anyway, so let's take a look at this. You can see this triangle that we had back here in November. We were talking about this for pretty much the whole month of November. And then we just zoomed up here at the first week of December, and we have been struggling to break this 44,190 mark. That was the high close back here on December 8th. We have been triangling again. I pointed this out a couple times over the last couple weeks. It's really interesting that this triangle culminates right around this D-Day for the ETFs, this red vertical line here. But once we break out of that, of course, we have some higher targets that I talk about on my professional tier newsletter and on bmpro.substack.com, Bitcoin Magazine's, premium newsletter that they have. I write for them as well once a week. But yeah, as the ETFs come, they're not going to launch right away. That's one thing that people don't quite appreciate either. And I haven't really talked about that very much because we don't know. When they get approved, they're approving a rule change for the launch of these ETFs. That doesn't mean they're going to launch like the next day. It could be weeks. It could be weeks to launch. The Ethereum futures ETF, all those ETFs, they launched very quickly. I think they were approved like on Friday, and they launched like on a Tuesday or something. But that was all due to the government shutdown. We don't have a similar situation here right now. So it could be stretched out to a month or so. And once we start getting further, the next thing on the calendar is I put this as a possible launch period in like the second week of February, and possible banking crisis here in Q1. This is my timeline. And then finally the halving here in April. So a lot of things going on in the first quarter for Bitcoin within this broader macro scheme of things. And a lot of people also think that Bitcoin, is primarily an inflation hedge. And if you guys are familiar with my content, which most of you watching this are, you'll know that we are trapped in a deflationary environment. At the end of a 50 to 75 year global credit bubble, everything wants to deflate. And to kick the can down the road means that they can temporarily reflate the economy, but they can't ever grow their way out of this, because growing in a debt-based system, growth is inflation. That's why we've talked about this when we look at the economic projections from the Fed, that as you go out 2 or 3 years, they have their inflation numbers at 2% and they have GDP at 2%. And that's not a coincidence. That's because growth does equal inflation in this type of environment. So you can't grow your way out of this. The deflationary pressure is going to be the overarching milieu that we find ourselves in here. So Bitcoin is an inflation hedge, but it's also a deflation hedge. And because in deflation, what that is characterized by is mainly defaults, also spreading contagion. So I don't want to do business with this other bank. I'm Bank A doesn't want to do business with Bank B because we can't trust their balance sheet. And then no one wants to do business with Bank A because they don't trust their balance sheet. So the contagion spreads, money stops moving, and it can crash very, very quickly. Because if you can't, these banks have overnight needs for money. If they don't get the money overnight, then they can literally default overnight. So it's when we have these financial crises, things can really accelerate very, very rapidly. And in those periods, you want assets that don't have counterparty risk. That's why gold will benefit. That's why Bitcoin will benefit in these periods. But Bitcoin as a monetizing asset is going to benefit way more than gold. So gold could double while Bitcoin 10x's. Okay, that's the kind of math that we're talking about here. Okay, so that's the Bitcoin price. We did looked like it might fall out of this triangle this morning, but we have been rallying later on in the day. Let's take a look at some of the oscillators. The RSI sitting above 50, but it's not looking super strong. So we'll have to be watching that. And MACD is also opening more to the downside. So some of these oscillators are telling you that it's not looking super strong, but we can consolidate in an upward fashion, just like we did back here in November. Bitcoin loves to triangle. It loves to do these type of things. So we will have to wait and see how that goes. Let's go to the weekly. You can get an idea of how quickly these things are coming up. So we have D-Day for ETF approval, possible ETF launch around the middle of February sometime, possible banking crisis at the end of Q1. That would be very similar to the banking crisis at the end of Q1 last year with Silicon Valley Bank and some of those other things. But it won't be like the underlying reason will not be the same. So last year it was deposits fleeing to higher yielding money markets. That's not going to be the case this time. It's going to be almost the opposite, where these banks are facing insolvency themselves just because they cannot access capital, because the shadow banking system is drying up. Speaking of the shadow banking system, let's take a quick look at the 10-year, because the 10-year is holding its losses here, or the yields are holding their losses down at 3.9%. And one of the reasons why you have an increased demand for treasuries, so the yields will go down as demand goes up, because it's the yields are the inverse of the price of the bond. If you buy a bond at like 98, then the 100 being the full face value, 2% or whatever, however that pricing works out. But as the price goes up to 99, that means the yields go down, right, to 1% or whatever it is. So the yields are inverse to the price. And as these banks are accessing capital in the shadow markets all the time, if they can't access capital, they have to come out of the shadows, out of the rehypothecation and the repledging of this collateral that goes on in the private repo market, not the Fed's repo market, but the private repo market. As they can't get access to a rehypothecated version of a treasury, then they will have to get access to a real version of a treasury in the real market. So you can see the rates falling, especially rates falling rapidly like they have here since October. That means that there is a squeeze going on in the shadow banking system. People are coming out of the shadows and into the primary market to purchase their treasuries. And that will continue. That will continue into recession. One of the pre-recession calls that I've been talking about on my stuff, as well as on Bitcoin Magazine Pro's newsletter that they put out, is this pre-recession era that we're in right now. As we go into a recession, if you go back and look at the history of all the charts and rates and stock market and all this stuff, going into recession, you usually see stocks rising and yields falling. And that is counterintuitive. Most people, when they see stocks rising, they think, oh my gosh, the market is so dumb. The market is doing the exact opposite. They're thinking that they're not seeing recession. The market's not pricing in recession. The market is thinking that we're going to have a soft landing or whatever the case is. But okay, one, the market's smarter than you. And if the market's doing the opposite of what you think should be happening, most likely it's the way you're seeing things that's wrong, not the way the market is seeing things. Stocks go up prior to recession because that money isn't going into the economy, into starting new business, into hiring new employees or whatever. It's being piled into retirement plans. It's being piled into stocks. It's being piled into investments and all of that stuff. And so stocks will tend to go higher as the economy is losing that bid versus the stock market. It really has nothing to do with people's expectations of the future. People's expectations of like future earnings from the stock market, especially when you factor in like passive investing, where there's just every month people put into their 401ks. People just passively just put it in there. And it usually goes to large mutual funds. It goes to index funds, things of that nature. There's not a ton of people like out there picking stocks relative to the total amount of people that are owning stocks. So that's kind of describes the pre-recession trade. Now, Bitcoin will also get a bid in this era as well because people are searching for more safety. Treasuries are safe, relatively safe. Okay. I know the arguments why that's not correct, but okay, let's just say that they are seen as a safe haven asset, but they have some counterparty risk. And not just the treasury itself, because the government, I would say, is a counterparty risk, but the more of the counterparty risk is the person on the other side of your transaction. So most of these people, 99% of people that are trading or buying bonds, treasuries, are not interacting with the government. That's the government selling them to primary dealers, which then warehouse them and sell them into the secondary market. So most likely you're dealing with somebody in the secondary market and you are doing a transaction. Maybe it's a repo transaction. If you're a big, large entity, maybe it's just, a everyday transaction, but you have to trust that counterparty that you're doing a transaction with. So it's not that the treasuries lose the safe haven bid from the government side, is that the market itself loses the confidence. So it is a safe haven, but it's a safe haven that has a breaking point. And we've seen that in the GFC, and we also saw that in 2019 with the repo rumble, and we saw that in 2020 with the COVID crash. So that is the new type of financial crisis where things can freeze up, velocity goes to zero, and everything can default like within a matter of days. And that is the financial crisis that the market is starting to become aware of and starting to see. So, okay, let's move on to another chart here. Let's go to oil because we are going to talk about oil here a little bit later. I think I just talked about this a couple live streams ago, but let's take a look here. So this is back when OPEC announced the cuts. This is the kickoff of the Hamas Israel stuff back here on 6 October New York time. It was 7 October Israel time, but it was still 10 p.m. on the 6th October time when it kicked off. And we did have a little bit of a bid, but since then it's been pretty straight down. And that tells you a little bit about the geopolitical concern of this expanding. All right. But another thing I just heard today was Iran said something about they're not going to get involved because Hamas can handle themselves. So, is this going to expand into a wider thing? We've talked about the Houthis and shipping, how that is going to cause a lot of problems. But overall, what the oil price is telling us is that this is not going to expand into a real big global conflict. I think this is just another chink in the armor or another straw on the camel's back of globalization, another straw on the camel's back of international free trade. And eventually the U.S., the U.S. couldn't get this coalition going, and nobody wanted to follow the U.S.'s orders and become part of this naval coalition, which would be a very unique type of situation there. But none of them wanted to jump on board. So it's kind of like, why is the U.S. even protecting these people, protecting shipping going to Europe? Why is the U.S. even involved here? Why are we paying hundreds of billions of dollars for this? Especially when we're going into recession, all that. So I'm not saying it's going to end right away, but it's starting to become a subconscious concern for the world that the U.S. isn't going to be there. And the U.S. is starting to really think hard about if we want to be involved in this whole thing. The U.S. doesn't lose much by disengaging. The U.S. will still be the largest economy in the world. Everyone will still want to have, at least bilateral trade with the United States. We're the largest producer of oil, largest producer of natural gas, largest producer of food in the world. So this overall, it's been an extraordinary burden to be the policeman of the world. It's been an extraordinary burden to have the global reserve currency. And so the U.S. actually benefits by disengaging. And that's slowly, I think, starting to dawn on a lot of people. And places like China, they have everything to lose, where the U.S. actually has everything to gain from the breakdown of globalization and stuff. But one thing, I drew this arrow in here last time we looked at that, and that was because of these EMAs. Let me take off that 20. We have the 50 in blue and the 200-day moving average in orange here. And I thought we would rally into this cross. We kind of did, and then it's a little bit late here, but we'll have to see how this develops over the next few days. If there is going to be some sort of breakout, I would say if we get here above 78 or even up to 80, that's when we have to start looking at maybe this is a trend change, and then we can start looking a little bit higher. I don't see it getting anywhere near these previous highs up here in the mid 90s, but we could see a few months of higher prices, in the short term. Eventually it's going down. And I wrote that big shale article about that, and we will read through that here in a second. Okay, so that I went over Bitcoin price, went over some macro stuff. Let's take a look at mempool. All right, so here we have mempool for the last 6 months. We almost drained all the way down here October 2nd. And where else? That's it for the last 6 months. You can see some of these peaks have very high transaction fees. So on the 6th and on the 16th of November, we had some high fees around the 16th of December, and then just around the 21st. But right now, we don't see a lot of these really high cost transactions. Let's go to their dashboard. Right now we're sitting at 121 sats per virtual byte for high priority. That comes out to be about $7.20 roughly per transaction. Low priority is down at $6.31. That's not as high as it was last week, but it is still pretty high. I'm not too worried about this. We've talked about this on the Telegram in the past when low fees, we probably brought this up in October when fees were so dang low, that was the time to consolidate UTXOs. And now people are all of a sudden understanding what that means. So if you have a UTXO that's only $5 worth of Bitcoin, it's unspendable because the fee is $7 just to spend that $5 worth of Bitcoin. So a UTXO that is less than the fee is unspendable, which is very interesting to think about because this could be considered a reduction in supply. So if you have, say, 100,000 Bitcoins total that are trapped in small UTXOs that have become unspendable, you actually have reduced the liquid supply of Bitcoin. And that will feed on demand. So demand probably hasn't fallen. Obviously, if we have high fees, demand for Bitcoin transactions is going up, right? It's so high. And so demand is going up, but each dollar that the fee goes up, it locks more unspendable Bitcoin. So supply goes down. Happens then? Well, supply shrinking and demand going up, you're going to have a big spike in price. Then those UTXOs that were $5 UTXOs are now $10 UTXOs, and maybe they become spendable, right? So there is the beautiful mechanisms built into Bitcoin that price going up, like I say, the only thing that matters, price going up unlocks a lot of these things. Everybody is aligned with their incentives for price to go higher. That's just how this system works. So as fees go up, it locks more Bitcoin into unspendable UTXOs. That reduces the supply. With high demand, you're going to get a spike in price. That should pull up the value of those UTXOs, perhaps unlocking them. It also could kick off a new round of hodling, a new round of FOMO, where people aren't going to be sending as many transactions. And so fees will naturally come down as the mempool clears. Okay, so that was some Bitcoin incentive talk. Let's go into ordinals. We have been following this on Bitcoin Magazine Pro. They do a mining dashboard. And when I took that over about a month ago, I've added in inscriptions. So you can track every week. You get an update on the number of inscriptions, how much that has changed in the last 30 days, et cetera, et cetera. So I also talk about this probably once a month or so on my free newsletter over at bitcoinandmarkets.com. But here you see this is via dune.com, dune.com/data always/ordinals. So you can check that out for yourself. But let's see here. So far in December, really the last week has seen a big surge in ordinals, but there is a slight decline. And I don't know if you can't see that very good. Can I zoom in on this chart? Can I zoom in? I don't think I can. Let me try to just do this. Let's see if that works. Does that make it easier to see? A little bit. You kind of see about right here on the 16th, there was a peak, and there was another peak here on the 24th. But overall, I would say over the last week, it has been declining slightly. The 7-day moving average is probably coming down. That's what I'm trying to say. 7-day moving average of inscriptions is coming down. Okay, let's take a look at some of these other numbers. Daily inscription spending for the past 120 days started going up here. Daily fees they have and cumulative fees. So far the cumulative fees, let's see what they are. $174 million people have spent on ordinals or inscription spending. I don't know if that includes all transfers or just the minting, but I think it includes everything. All fees associated with inscriptions has totaled $174 million in the last 120 days. We can see that spending peaked back here on the 16th, and that was what I was talking about right here. This was the 16th, right? Yeah, so this peak right here corresponded with the high spend. And actually, let's go back to the mempool and go to the graph. That's November 16th. Come on. Are you thinking? There we go. So let's see where this was. This peak right here was December 16th. And why doesn't it show up? All right. This peak right here, December 16th, that was also the peak in the ordinal spend and the number of ordinals inscriptions. So you see how some of these things kind of line up, which is very interesting. All right. So what was that spend on that day alone? 10 million. I've seen other numbers as high as I think 50 million. Well, no. 29 million in a day. Maybe that was on this. Yeah. So see here, this is fees spent on inscriptions. So what the hell is this all about? Daily inscription spending. Okay. Not sure what the difference is there. If you guys are watching, pop down in the comments. Tell me why that's different. But okay. This here is December 18th. And yeah, they spent here 32 million total. 28 million of it was over 100 sats per virtual byte. That is extremely expensive, right? That's what we were just looking at, $7 per transaction. But that's not an inscription transaction, because I think inscriptions can take hundreds of transactions just to get all that data into the blockchain, into the data storage. And so at 100 sats per virtual byte, I mean, you could be talking $1,000 transaction or $2,000. And if you're minting something that is, really has no market value, are you going to continue to waste 2,000? I mean, maybe at the beginning of a cycle where you think, oh, this is going to catch on and I'm going to be able to pump and dump these things, then maybe that would be worth it to spend $2,000 to mint a collection of inscriptions or something. But as that wears off, which I think it will wear off a lot faster than the initial NFT cycle did, then that fee is also going to be aligned to make it uneconomic to do what they're doing. So this will eventually take care of itself, in my opinion. But okay, that was back then. And now we're down to only about 3 million in spend for inscriptions total. Okay, weekly inscriptions by fee rate. Most of them are the very expensive. All of them are over, it looks like to be 99% are above the 50 sat per virtual byte level. Okay, very interesting. Count of weekly inscriptions by type. You can see in orange, this is the BRC20 mints. These are the ones that people don't like because they're extremely wasteful in usage of block space and that kind of thing. So also, as the fees go up, BRC20 should lose its dominance, and you kind of do see that. So if you go back here to November, you start seeing this pink, which is, I guess, plain text. As you can tell, I'm not a expert on the inscriptions and ordinals, but plain text is starting to get a significant portion of this. Back in November, it was about, what would that come out to be? About a third of the BRC20 mints. And that is pretty close to where we're at today. Let's see. Okay, now it's a little bit less than a third of that, maybe getting down to about 30% of the BRC20 mints. But as fees go up, these BRC20s that are less efficient, they are going to lose out, and more efficient inscription, if this is a real market, if it's not completely fake, then the BRC20 should lose out and the other inscriptions and stuff should take over. Okay. Share of block space by these things. You can see that Right now, we're sitting under 40%. We did touch 40% back on 11/20 and also back on in May, about May 8th. What else we got here? Media inscriptions, blah, 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 spending. Bitcoin taproot utilization, way over 40%. BRC20 operations. Okay, this is the one I talked about last time as well. Let me zoom in a little more if we can. That doesn't really help, does it? So anyway, here, if I hover over this, you can see on December 24th, Christmas Eve, mints, 219,000 mints, but only 23,000 transfers. So it's still about a tenth. The mints are even transfer. Maybe that, I don't know if that has to do with selling. Do you have to transfer it once and then you can go on layer 2 and transfer it a bunch of times? But this is not looking like a robust market where the secondary market should be bigger than the primary market. Okay, the mints should be 10% of the transfers. If this was a vibrant market where there was a lot of demand and people were buying and selling, the transfer number should be 10 times bigger than the mint number. But right now we're seeing the mint is 10 times bigger than the transfer number. And yes, it's new. It's less than a year old for all this stuff. So we will have to continue to watch this. But this does not look like very organic market to me right now. It looks like there is some funny business going on. Minting is taking over. There's a lot of maybe people minting now, hoping that they can get a chance to pump and dump them later, something like that. But yeah, I'm not too worried about this, but that is the overall situation here on ordinals. Okay, let's go into the discussion on AI. And if you guys, I'm just going to pause here and say I'm live streaming on Telegram, YouTube, and Rumble. To join the community, check out the Telegram, t.me/Bitcoin and markets. We're cutting it up in there all day, talking Bitcoin and macro. A lot of people will find things and post them that I have missed, and then I'll forward them to the front page of the channel, whatever you call that. And yeah, so we have a lot of dialogue going on in there, and it's fun. It's good to have a small, pretty tight community. There's a lot of guys have been in there for years, and at least they started on Discord and they moved over to Telegram. So yeah, it's a pretty cool community, and I appreciate everyone that partakes in that. And if you're watching on YouTube and Rumble, please comment down below. Like at the end of this live stream, I will go through the comments and see if people have any questions. Okay, AI. This was a tweet back from December 20th. There was an article on Zero Hedge. And actually, let me bring that up first. Okay, so Zero Hedge. The article headline is Google to limit answers to election queries on Bard AI tool and generative search. Google released a blog post on December 19th explaining it plans to implement restrictions on specific election-related queries that its artificial intelligence bot Bard and its search generative experience can answer. It said this restriction will be enforced by early 2024 in the run-up to the presidential election in the United States. More censorship, right? The post pointed out that 2024 will see many other important elections around the globe alongside the U.S. presidential election. So they want to interfere with all of them globally. It said it will, quote, work with an increased focus on the role AI might play. One of the primary priorities Google named was to help users identify AI-generated content. Okay, that's the line that I want to kind of hone in on. So it's AI-generated content being censored by AI. So this AI is generating content. It could be correct and truthful content, accurate and truthful, or it could be noise. But this AI is going out there and restricting the signal, if there is signal there. And so when you restrict signal, noise to signal ratio goes up, right? Because there's more noise per signal available. And that was my response to this. Now going back to my tweet. is that AI created content moderated by AI. They're all noisemakers. The future of AI is going to increasingly be finding signal through AI generated noise, all controlled by economic considerations. So, yes, just like when the internet came, in the past, you had libraries where you would go and you would have to look through the card catalog by subject, and you would find the books. One of my favorite places on campus in college was the library, and I would sit there for hours just going through and following lines of thought through different books, right, on a certain subject. And a lot of it was economics because that was my major, but that was how we did it in the old days. There was the noise. There was very little noise. Most of it was signal, because if it was in a textbook, if it was in a reading list for these classes, most likely there was signal there. Now, you could disagree, especially in economics, how much a signal is, but the signal to noise ratio was pretty high, signal to noise. But then when the internet came around, the noise got a lot higher. There's a lot more noise. I don't really believe that there is that much more signal out there. One of the things I think in the future, we're going to have channels like this one and maybe others where they have built up trust. They have built up a following that can go through and weed out the noise to signal. And that's what communities will be built around. It would be built around a signal. But this isn't an imposed signal. You can feel free to watch the content or not watch the content, find another signal producer out there. But the internet created a situation where noise took over and signal was much harder to come by. Now, what's going to happen when you take that to the AI to the 10th degree? Noise is just going to go through the roof. No one's going to be able to find signal. And now you have AI created content moderated by AI. It's going to be almost impossible. It's one of these things where I'm not sure exactly where this comes from, like what kind of field this comes from, but as it kind of reminds me that it takes more to debunk something than to create the false claim in the first place, right? There is this trade-off of, say, it takes you 10 minutes to debunk something, but it takes 1 minute to create a new claim that needs to be debunked. So it's constantly, noise works against you. Noise is an economic attack against the signal. And as we go forward with this AI future, that's what I think we're looking at. Okay, so then I tweeted today again about I can foresee two problems with excessive AI bullish calls or excessive bullish calls on AI. Number one, AIs will have a signal problem. Just what we just covered. Almost certainly, all AI is going to do is increase the noise. All right. And you're going to have to use an AI to weed out the noise. But is it going to be enough? Like, there's going to be this arms race between noisemakers and signal finders. All right. So that's a problem in my mind. AIs suppressing and elevating content based not on truth or accuracy, but on political ideology. Simple AI spam creation will block or hide useful signal. Okay, and number two, the second problem that I foresee is AIs depend on energy and infrastructure, which has physical limits. Decision-making is rooted in physical trade-offs. So what I'm thinking of here is, all the compute necessary. They have huge, big data centers full of GPUs that maybe used to be mining Ethereum are now, a lot of them, and new stuff is coming out and backing this AI or used in AI calculations and AI infrastructure. Okay. That's all takes energy. So these AIs, they're expensive to run. They're expensive to build. They're expensive to learn. All of this stuff is expensive, and it has physical limits. So you can't make an infinitely big AI. You can't make an infinitely big data center. There's these physical limits, and decision making is rooted in physical trade-offs. So not just decision making, but also signal to noise, being able to make any economic decision. Is this AI actually economically viable? Well, that's going to be rooted in physical trade-offs. Okay. AIs will have to interact with the market and money specifically. And AI will have to prioritize profitable activities. So if you live in a world where you can't spend all of your resources doing everything, you have to select and prioritize profitable activities that will be, satisfy these trade-offs. So you have to do that, else it'll waste resources in a finite competitive world. So yeah, right now, there's all these AIs that you can go and use for free or whatever. We don't know how they're programming you. I mean, usually if something's free, you're the product, right? So these things are living in a finite competitive world. They're going to be creating competitive noise. They're going to be censoring each other. They're going to be doing all these other things. So they're going to have to prioritize the profitable activities. So how does an AI know about the trade-offs and the market to know something is profitable? Is the AI, I mean, they could be programmed with some communism, right? But that's not going to last very long. I mean, if AI can do all these things at millions, billions, trillions, quadrillions of times faster than a human brain, they're going to run into the reality of communism really quick, like in a second. They're going to find out that these type of trade-offs are dumb, don't work. So how are they going to learn about trade-offs and about the market? How are they going to know what's profitable and not profitable? This goes back to the calculation problem. It goes back to people thinking, oh, if you just throw enough compute at the modern economy, you can find out, you can centrally plan perfectly. Of course, it's not real. That's not possible. But a lot of people think that. So AI is going to have this problem too. It is an unsolvable problem. And how are they going to learn about these trade-offs to make profitable decisions? Well, it will have to use money. It's going to have to appreciate money, use money. And it wouldn't really want to choose fiat or government legal tender because that can be seized, that can be manipulated. So censorship resistant money with the cleanest price information. That's what they're going to want. They're going to want to use Bitcoin. AIs are going to want to use Bitcoin. They're going to use Bitcoin prices. They're going to use Bitcoin bids and asks and all that stuff to earn money, to make sure that they're acting in a profitable way. And so if that is the case, they're locked in. They are just another economic participant like everybody else. And they are having to spend, they have this signal to noise arms race that's going to go on. And really, all in all, the benefit to cost is just going to be another typical economic participant. That's all it's going to be. That's my opinion. And so that's why I think these are two problems with the AI arms race. Okay, that's that. If you guys have comments, put it down below in the comments. I'll also check on Telegram and see what you guys have added. But let's go now back to bitcoinandmarkets.com. And I wanted to go quickly through this shale oil post that I just made public. Went out first to paid subscribers. So if you want to support my content and get immediate access to my blog posts, you can join $5 a month over at bitcoinandmarkets.com. I appreciate everyone who supports this. This is a listener-supported show and podcast and whatever, live streams. So I've been doing this for a long time. I did have in the past, I had some sponsors, very few though. I had one and I didn't really like it. I'm not a great marketer of my content, but I didn't didn't like, I did eToro, if you remember that, and it turned really into a scam thing. So I didn't renew it for a second period that I was doing eToro. But 99% of the history of this podcast, going back to 2016, has been listener supported, and you guys make this possible. So I appreciate that. Okay, discussion on the scale of the shale revolution. There are important geopolitical developments, and then there's the U.S. shale revolution. Important geopolitical events are usually small, like a regional war, major shifts in trade agreements, etc. However, the shale revolution ranks up there with events that completely change the world order, like the world wars or the breakup of the Soviet Union. It's that big. U.S. oil production is a pivotal part of my macro thesis. As the U.S. becomes less reliant on the world for necessities like oil, the natural force of geographic distance begins leaning it toward isolationism. So this is a natural standby. All right. So this is a natural process that as you uh, take away the dependence on the rest of the world, the geographic distance of the US from the rest of the world and the completeness and self-sufficiency of our economy is naturally going to lean it towards isolationism. We have enough problems here at home. We're not perfect. No one's perfect. Okay. We have enough problems. We can't even take care of our own people. But that not being dependent on the world for basic necessities like oil, we will naturally lean towards isolationism. That is the almost 100% certainty that we're going to lead towards more isolationism. And we have been. Fewer troops are stationed abroad than any time in U.S. history, I think, going back to over 100 years. I mean, going back pre-World War I, this is the fewest overseas troops that we've had. We still have the bases around, but we probably will start losing those as well. This is my kind of opinion on that. But okay, let's continue with this. The U.S. wanted to defeat communism and did that by globalizing the rest of the world through enforcement of international agreements, peace between great powers, and free trade, all things that are great for business. So people nowadays, especially my generation or younger, they think it's always been this way. The U.S. is the big bad guy out there and starting all these conflicts around the world because of the petrodollar, because this or that. But in reality, there has been one other globalized era that's kind of similar, and that was pre-World War I. Okay, that was pretty globalized, but not to the extent that we have globalization today. I mean, we have the free trade is a aberration in the history of the world. I mean, the steady state of the world is piracy and privateering, and you fighting your neighbor on a relatively frequent basis. That's the steady state of the world. It's just been in the last 100 years that we've had this concept of globalization, and especially in the last 50 years that we've had the extent of this globalization. It's not going to last. It's going back the other way. But the U.S. created this to defeat communism. This is a Peter Zion idea, and I know a lot of you guys don't like Peter Zion. I think he has some of the most idiotic calls politically, ideologically, and on Bitcoin. But his basic geopolitical comments, I believe, are fairly accurate. Okay, post 1991 and the breakup of the Soviet Union, no unifying narrative or grand vision has successfully taken over. So the grand vision was to defeat communism. We will take on the extraordinary burden of being a world policeman, of creating all these international organizations, the UN, the WTO, the IMF, World Court. We will create these things. We will fund them. We will back them up with our globalized system and of our alliances and all this stuff. Okay, that's what built this whole globalization out. And the guiding principle was to defeat communism. But that's over. And there is no unifying narrative or grand vision that has successfully taken over. 2 attempts were made by competing factions within the West to create this new unifying story for the world. And you need this unifying story to give the underlying impetus to globalization. One faction is what we colloquially call the neocons. They focus on the enforcement of order. So if we go back up here, we have global policemen, enforcement of international agreements right there. Enforcement. So the neocons, they focused on enforcement of order. And they tried to create global unity around fighting terrorism. So that was the global war on terror. That is kind of an amorphous enemy. And they wanted to enforce order through creating a common enemy. The global war on terror importantly had a global aspect with its coalitions to go fight a never-ending police action in the Middle East. This faction was vulnerable to crony capitalism and government deficits. There was a ticking clock to how long the neocons could last, represented by the government debt to GDP. So as debt to GDP went up, crony capitalism would break down, and this neocon enforcement of order for order's sake would break down as well. Okay. The second competing faction was the bureaucrat class. They focused on supranational cooperation through unions like the EU, the European Union, and global climate initiatives. The European project was their stronghold dating back to the 70s, and they grew from there. I call them globalists, Davos, or Marxists. So, of course, Davos man came from Tom Luongo's thought, cultural Marxist, global Marxist, that comes from woke ideology and cultural Marxism and stuff like that. But kind of the grab all for everything is globalists. Their coercive bureaucratic tactics were extremely vulnerable to Maoist style cultural Marxism due to its concentration of power outside the confines of Western law. So the laws are usually for your nation, your national laws. Well, if you form a treaty above your nation's laws, you are creating this global fabric of being outside the law. And that's extremely vulnerable to takeover, because all of the checks and balances that you have usually within a nation, whether that be the US or Germany or wherever, you have these checks and balances. And those checks and balances don't work when you create a treaty above those checks and balances, right? So that's extremely vulnerable to attack. And that's, I think, exactly what happened. 30 years later, it has completely devolved into a hodgepodge of radical cultural Marxists. Both these factions have failed and are at the end of their useful lives. Government debt is too high to continue the neocon strategy, and globalists are too radical for the average sane person around the world. Some might add the Thucydides trap as some sort of uniting Western force. So we're losing Western civilization. You'll hear that all over the place. We're losing Western civilization. We're losing hegemony. U.S. hegemony is going down. We need to fight for our national interests everywhere in the world, and that includes imposing not only our enforcement mechanisms, but also our bureaucratic class on the world. So that's kind of this idea of the Thucydides trap and why it could be a cohesive message out there. But conceit is not a globalizing motive, and it's actually backwards. The U.S. wins the Thucydides trap by refusing to play and embracing isolationism. So the U.S. doesn't depend on the rest of the world. It's only 10% of the U.S. trade, and it might be less now. This is a couple years old. 10% of U.S. economic activity is from trade outside of North America. Another 10% comes from Canada and Mexico. But 20% total of U.S. economic activity comes from international trade, 10% from outside of North America. That is very, very low. I don't know if it's the absolute lowest in the world, because there are some tiny economies that have almost no international trade. But of the major powers, it's extremely low. I mean, China is somewhere 30-40%. I think Germany's at 30-40%. Those are countries that are much more dependent on the globalization system. So the U.S. wins by not playing. So that Thucydides trap does not make any sense. where you have to stay engaged to keep your hegemony. Well, actually, the thing that's going to benefit the U.S. most is to not play and go back to isolationism. If they do that, globalization breaks down because there's no customers and security costs skyrocket, as they're finding out with the Houthis in the Red Sea. Security costs are going up because there's war risk insurance that they have to pay. There's also extended amount of fuel that you have to burn. I saw some math by Sal. He does the what's the ship channel? I believe it's what's up in shipping. I can't remember the name of his channel now on YouTube, but he did some back of the napkin math, and he found out that it's about $500,000 difference in fuel alone to go around Africa versus to go through the Suez Canal. So it's much more expensive. The security costs are going to skyrocket. Costs in general are going to skyrocket. If India has to patrol the Indian Ocean to keep trade safe, it's going to cost them a lot of money. Their defense budget is going to balloon. If China has to go and patrol the South China Sea and patrol the Straits of Malacca and the Hormuz, that's going to be extremely expensive for them. So anyway, globalization breaks down, no customers. Also, the U.S. is most people's, or a lot of people's, end consumer. Okay, that's one of the problems with China is they make a lot of stuff, but nobody will buy it. And it's not like the Field of Dreams. You build it and they will come. No, you have to have a customer. The customer is always right. And the U.S. is the biggest customer out there. So you have to have customers. And if globalization breaks down, then there's going to be no customers and your costs are going to skyrocket. The Chinese economy and the CCP would collapse, or rivalries and blood feuds would reemerge everywhere. Not just China, but everywhere. We'd have these rivalries and blood feuds. We'd see things like the Middle East kicking off everywhere. We see stuff in Eastern Europe, just like we're seeing. This is all because of a breakdown in the international order. If the U.S. withdraws support for the system, it's the rest of the world that will need to adjust negatively. And then I have an image here. Okay, energy independence. Since 1991, it was the U.S.'s reliance on foreign energy that created the need for the international system's continued existence. The international system, in turn, needed a grand vision to give it meaning. This is what gave air to the above competing factions. Hey, buddy. My boy just came in. 1 second. All right, I'm back. He didn't shut the front door, that boy. Okay, since 1991, we talked about this. Okay, let's just read this paragraph again. So since 1991, it was the U.S.'s reliance on foreign energy that created the need for the international system's continued existence. So the U.S. needed that foreign energy. So we wanted to protect the access to that foreign energy for ourselves. And so the international system needed to continue after 1991. But the international system, in turn, needed a grand vision to give it meaning. So it wasn't just because the U.S. wants it. It's because we're fighting terrorism, because we have globalization, because we have all of these uniting treaties of climate treaty or XYZ treaty. So all these are uniting sort of narratives. But the grand vision, it needed this grand vision to give it meaning. This is what gave air to the above competing factions. Okay, that underlying impetus is now gone. The last few years has been dominated by these groups trying to create a new reason for them to exist. Climate disaster, global pandemics, war on terror, Russia, etc. They've even joined forces to keep down popular movements around the world, from the U.S. to France to Pakistan. Of course, Le Pen in France, Imran Khan in Pakistan, and Trump in the U.S. For example, neocons in some nations have joined with the radical globalists in trying to marginalize emerging popular leaders. We saw this down in Argentina. The coalition that worked against Milei, who was the populist leader, coming in, and both sides of the existing order was working against him. They joined forces. And when those leaders still overcome the odds and win power, like Trump, Meloni, and Orban, these two sides work to undermine them. So in Hungary, they're constantly talking about Orban and refusing to give them the not subsidies, but payments from the EU that they deserve. I mean, they're part of the union. They pay into the union, and they should get whatever payments out of the union that they have signed the treaty for. But they're withholding money from Orban in an attempt to undermine him, right? And calling him names and doing all this stuff. Similar stuff, they're trying to paint Meloni as some dangerous character. All right. The global narrative emerging is a return of populist nationalism. Populist nationalism is not a globalizing, unifying force. Populist nationalism is a separating force. It's working directly against globalization. This would not happen if the motivation of the U.S. to maintain the system for energy needs was still acute. We are on the verge of disintegration. So if the U.S. still needed all of that oil from the Middle East, we would be more motivated to keep this system together, but we're not, because we are relatively energy independent. So there is no huge motivation to back this. And every decision is going to be fractionally moved towards isolationism. Every decision there's going to be an easy out. Like, why do we care? Let's just end this early. Let's make this easy decision because we don't really need it. We don't really care. It's too much headache. Let's cut our losses and do this. So every little fractional move is going to be towards isolationism. The fractional moves are not going to be towards more globalization, more international trade. That's looking forward a decade or two. That's what's going to happen. And so the biggest losers are going to be those like China that are most dependent on this international trade. All right. U.S. oil production. Currently, the U.S. is the largest oil and natural gas producer in the world. It still relies on foreign refining capacity, but that could be taken care of in less than a decade. So we could, if push comes to shove, we could build more refineries in the United States, especially if the populist nationalists take over. So on the flip side of refineries is those countries rely on that income. So it's not like there's a vacuum and the U.S. is the only one dependent on those refineries. No, those countries that have the refineries that we're using, they rely on the income that the U.S. gives them to refine it. So there's a codependency there. It's not a one-way dependency. All right. This rise is far from over. The U.S. has by far the most shale oil reserves, and the technology keeps improving. Recent advancements promise to double the productivity of shale wells, and I linked to that article. Refracts are also gaining in popularity. That is the practice by which an old well is re-stimulated to start producing oil again. One company in South Texas has said that refracts with their new specific liner technology can even outproduce new wells. All this is pushing down costs and break-evens. So you can see this here. These are the break-evens for the different shale fields, United States shale fields. So new wells let's go to the Permian. New wells break-evens is at $58 a barrel. However, existing wells down at $29. And if we have all this technology that is making wells twice as productive and refracking that can make old wells even more productive than new wells, then the break-evens are going to move towards this 29. Not towards the 58, but move towards the 29. I bet it's around 40 right now. I think 2 years ago it was about 45. I don't know. That might be a average of this because I've quoted the 45 number before. That might be an average. It might be getting down to 40, maybe even $35 a barrel as a break even for some of these existing shale fields. That means it's more profit, right? More profit for the company. The climate globalists can't stop this. The more restrictive policies the current administration puts on the industries, the more it stimulates technological advancement. The intended consequence of strict regulation is to keep the U.S. more involved in world affairs. And I've said this a lot since Biden came to office, being a globalist, representing the globalist side of this conflict, is that they're putting on these restrictions on the U.S. oil industry because they want to keep the U.S. more involved in the world. If they just let drill baby drill, there'd be less reason for the U.S. to be involved, and we would isolate faster. However, they can't win because by putting on those restrictions, you stimulate technological advancement. Okay. The unintended consequence is to make the shift to isolationism that much stronger and inevitable. Trump is likely to win the next presidential election in the U.S. and has already said his first policy will be to drill, baby, drill. Okay, so I think that's important. They cannot stop this. They cannot win. The harder they push, the more technology will get build up. And when the drill, baby, drill eventually does come, it's going to be really drill, baby, drill. Now it's going to be drill, baby, drill at $35 break even instead of $45. So they can't win. They might be able to delay this a little bit, but the eventual outcome becomes stronger and more inevitable. Okay, this opens up many geopolitical strategies. If the U.S. wanted to, they could use oil as a weapon. Opening up the taps, it would drive the price of oil down and put strain on OPEC plus economies. That includes Russia, right, and Iran and other oil-producing countries. They have already cut production, and countries have started leaving the alliance. This just happened last week. Angola said they're going to be leaving OPEC. Saudi Arabia has a budget deficit and is surrounded by enemies. It also makes the U.S. strategic rivals much more reliant on global choke points than the U.S., which is a big problem, as we've seen with the Houthis. So the more reliant you are, the less reliant the U.S. is on global trade, the less reliant we are on those choke points. And the more relatively reliant those other countries are, the strategic rivals of the United States. Okay, imagine if the U.S. was behind an effort to close Hormuz or Malacca. I thought about this recently about the Houthis. Like, who has the most to lose by this? What's the saying? Cui bono. It's not the United States. The United States does not have the most to lose. They have the most to benefit from this trouble in Hormuz and trouble with international shipping, because our relative advantage will increase. The more the U.S. pumps, the more geopolitical weight it has, and the less it will care about the rest of the world. New production or new counting of oil production. This brings me to the thing that sent me down this rabbit hole. So it's kind of a long circuitous route here, but Nick Natal said this. He said, U.S. shale production is not suddenly surging. This bearish narrative, we believe, is wrong, has been extremely damaging to sentiment, and is rooted in the EIA's recent inclusion of natural gas liquids. Oh, damn, I just opened up that. Anyway, natural gas liquid production in their weekly reported calculation of oil production. All right. So I was like, what is this with the natural gas liquids? Why is that being counted? All right. So I went down this rabbit hole. He is attempting to pour cold water on oil bears like myself that think overall, over the next decade or two, oil prices should fall. Thinking oil will drop in price. Pointing to the recent rise in U.S. production to record levels is being tainted by a counting change. Quote, this bearish narrative we believe is wrong, has been extremely damaging. Okay, I said that, and this was his chart that he used. Let's open this up if I can. I can't open it up. But you can see the blue line here is the weekly data, and he compares that to the 9/14 data. So this is important. He's saying 9/14 in his post. He went on to say the 9/14 is more accurate, and it's not showing such a huge spike. See that? This blue is spiking a lot more than the orange. It's more gradual. And he's saying the blue is implying more bearishness because the supply is increasing faster. So that implies more bearishness for the price, where if we concentrate on the orange line, it would be much more smooth, okay? But there's a problem with that. I spent some time researching it, and this is what I found. The EIA had a problem with their numbers. Things weren't adding up. And this was known for years. The supply and demand numbers were being adjusted by as much as 2.3 million barrels per day to make them balance. So we know really about the demand side, okay? But the supply side is harder to count, and these weren't matching by up to 2.3 million barrels per day. And, if the U.S. is producing 13 million barrels per day, that's a huge chunk. That's 10% that this was having to be adjusted. Oil traders started calling this the missing row on the supply and demand data, and it kept growing. It got so embarrassing for the EIA that they undertook a 90-day study to find the missing oil. They found out that the way they were counting oil production was wrong due to blending of oil and natural gas liquids. And natural gas liquids are not like liquefied natural gas, LNG. These are things that fall out of natural gas. So I'm not an expert here, but from what I understand is when the natural gas comes out, it experiences decompression, and that decompression is going to allow things to separate. And you get natural gas on one side, and then you get the natural gas liquids will precipitate out of the natural gas as it decompresses. So these are things like down here, let me just read off this: ethane, propane, normal butane, isobutane, and natural gasoline. So those precipitate out. Those aren't considered natural gas. They're considered natural gas liquids. All right. And they were being blended with oil before they were sent to these refineries. And that blending mechanism, whatever it was causing a miscount somehow of the oil. Okay, so they fixed that. So in 2023, they went back and updated the 2022 data. And that 2022 data is the 914 that Eric Natal mentions. So going back to this, the corrected data is the orange line. They retroactively went back and corrected from 2022 onward. Okay, in this orange line. So you can now see this in the column transfers to crude oil supply. Starting in July, they started doing this for new weekly production data. So how they calculated the new data didn't change until this point. So he is correct that this is rising less quickly. But the reason why is the same reason why he's saying that this is inaccurate. He's saying this is inaccurate because of the way they count natural gas liquids. But the reason why this is more accurate is because they counted natural gas liquids further back. Okay. But let's take a look at this. So this is the new table. You can find this in EIA stuff. You can see transfers to crude oil supply. And this is a new column that is only available from January 2022 onward. This is for September, I believe. This is the most recent month data that they have. And you see crude oil here. Field production was 397,000 barrels. Or sorry, that would be, I think this is thousands. So this would be 397 million barrels. All right. And then down here on the hydrocarbon gas liquids, we have natural gas liquids, which includes all of these here that I just talked about. That was about 16 million barrels that were transferred to the crude oil supply in this blending process, apparently. I'm not sure exactly how that works, but that you can see right here, about 16 million barrels were taken from these hydrocarbon gas liquids and put into the crude oil supply. There was also another one down here of other liquids, about 5 million barrels, 5.5 million barrels of other liquids that were transferred into the crude oil production supply as well from this blending process that they do. Overall, well, let me just continue reading. So as you can see above, in September, the most recent month of full data, under transfers to crude oil supply, there's a total of 21 million barrels added to oil production from these other liquids. 21 million over 30 days is 700,000 barrels out of the 13.24 million barrels per day total. So it comes out to about 5%. Now, these aren't technically crude oil, but they're counted this way. They're counted this way in trade. They're counted this way, all this stuff. I mean, if you blend it with a little bit of propane or something, I'm guessing that you get that's how it all is. So it still counts. They still have a certain amount of BTUs per liter or per gallon or per barrel. I don't know exactly how they count that, but there is still very high BTUs per barrel for these NGLs. Anyway, 700,000 does not cover the whole discrepancy problem. So remember, I was talking about up here that they were off by, where was it? They're off by 2.3 million barrels per day in their counting. And so far, what they have found is they have been able to correct it to 700,000. So they found 700,000 of this discrepancy, but they still have a long way to go in fixing the discrepancy completely. So I think they will likely make more improvements in the future. To Natal's point, though, this update does not decrease the bearish trend of high production. It does help traders understand the makeup of the market better, and that might create a change in price, but the trend remains the same. Oil supply is increasing, promises to increase a lot more in the future. Demand is falling going into recession. Global trade is slowing, and demographics have locked in this trend for the foreseeable future. So that's where I ended this post. All right. So let me check the comments. Let me just go to the homepage of bitcoinandmarkets.com while I take a look at some of the comments from the chat. Dex Invictus, what's up, buddy? Hope you're having a nice holiday. Yeah, thanks. Back at you, man. I had a good Christmas with the in-laws and got a chance to Skype with my mom for a couple hours. Of course, my kids are around, and we had a great dinner, Christmas dinner, even Christmas Eve dinner. We had some prime rib for Christmas Eve, and then we had some turkey yesterday. So it was great. All right. Hope you had a good one too. All's well that ends well. Yeah. I mean, which way are you talking about? Which exact macro stuff are you talking about? I think that it's going to, macro wise, I'm actually quite positive especially for the United States and U.S. allies, trade allies, Japan, Mexico, Canada, the UK. I'm and maybe even South America, maybe Argentina signs a contract. There is also the Caribbean Free Trade Alliance with the United States and Central America and all that stuff. So all those countries are going to benefit. So I'm pretty bullish on all that. But some countries like China are not bullish at all. If you're talking about AI, so guys just joining now, we were talking about how AI has a couple pitfalls, and the two things that I mentioned were that AI will have a signal problem because they will be competing. They'll be suppressing each other. They'll be spamming each other. They'll be based on ideology, and it's going to be a big problem to find signal through the noise. And if there is some sort of economic viability, there's going to be physical trade-offs. And so they're going to have to use money to understand those physical trade-offs. So that's what we talked about with the AI stuff. Okay. Let me check Telegram, see if there's any posts in here. Spagball says, can I put this recording out? Yeah, I'll link it in Telegram. I'll link a new one or this whole recording in there. You won't have the visuals, but you will have the audio. Oh yeah, someone else says you can go back and watch it on YouTube. That's true too. But I mean, I like Telegram. I like the Telegram interface. You can speed up, slow down. So it is a good place actually to listen to recordings and to listen to live streams there on Telegram. So I will post it again in Telegram for you there, Spag. But all right, that's all the comments for today. Thanks for joining me, guys. Merry Christmas. Hope you have a happy week here from Christmas into New Year's. Spend time with friends and family. Remember what's important. Bitcoin will go up. Stay humble. Stack sats. Stay humble. Make babies. That's it for me. All right. See you on the next one, guys. Bye.